Good afternoon. Welcome to GRESB's Infrastructure Results Event for Europe, Middle East and Africa. My name is Stephen Pringle and I'm a Director in GRESB's Business Development and Client Relations team covering EMEA. As I hope you're aware of this format of this year's results event has an element of change to it, and the most obvious being virtual and online as opposed to the former in-person events. So whilst this is disappointing to GRESB and all of our members as we enjoy the human interaction, it does, however, allow us to reach a wider audience. And the second major change is that we've decreased the time dedicated to specific results so as to allow the expert panels to discuss more important topics relating to sustainability today in our region. An important note, the slides for today's webinar will be available and sent out to all attendees after the event. So a few housekeeping items to cover. If you have any questions, I'll ask you to please raise those in the chat function at the bottom of your Zoom screen, and we will take questions at the end of the last panel. Now, if we do run out of time, we will answer any unanswered questions following the event. Okay, so let me just have a look. With a couple of minutes past the hour, and I see the numbers of the attendees are increasing, but in that time, what I'd like to do is introduce all of our panelists who have kindly given up their time to take part today. So in the first panel, discussing the evolution of ESG standards and EU disclosure regulation, is GRESB's Head of EMEA, Yassine Peak, with GRESB's Infrastructure Director, Rick Walters, and also Edward Dixon, Head of ESG Real Assets at Aviva Investors. And in the second panel, we have GRESB investor member David Bentley. David is a partner of Atlas Infrastructure, a listed infrastructure manager with offices in both Sydney and London. Now, Bengt Egner is a partner from GRESB's infrastructure partner, Klinkby Egner. And this panel, Climate Change, Disclosure and Adaptation, Decarbonisation Targets, will be moderated by GRESB's Climate Change Specialist, Eric Landry. Now, the final panel on acute risk mitigation and business resilience in relation to COVID-19 includes three GRESB participants. Catherine Sherwin, who is the Global Head of BlackRock Real Assets and ESG Integration and a Senior Member of the BlackRock Alternatives Investors Sustainable Investing Team. A second panelist is Des Wilkins. Des is a Vice President at Hermes Infrastructure, focusing on asset management across a portfolio of 13 direct equity investments, spanning utilities, renewable energy, transportation, and ports. And finally, and most impressively, Bansi Chidasama, ESG Committee Member, Arcus Infrastructure Partners, who despite being on maternity leave has kindly agreed to take part. And this panel will be moderated by GRESB Infrastructure Associate, Katie Greneman. But before these panels, I'd like to invite Rick Walters, Infrastructure Director, to deliver the 5th edition of the infrastructure results. Go ahead, Rick.
Thanks, Stephen. Hope everyone can hear me clearly. It's fantastic to be here today and presenting to all of you. My sort of change is the ugly looking moustache that I'm sporting from November. So bear with me on that one. Just a reminder, many of you know this, but GRESB is at the end of the day, a collaborative ESG data platform. It brings together assets, funds, and their managers who provide the very important ESG performance data and get the analytics back from GRESB, and that connection to the investors who then get to see and understand the ESG performance of their investments, and then becomes a place to engage on that performance with those funds and assets. And at the end of the day, this is kind of the point of it all. And also a reminder of the structure of GRESB infrastructure. We have that 2-level assessment with the funds at the top here, the fund assessment comprising 2 components, a management component, performance component. And the performance component is essentially the aggregated asset contribution from the underlying assets of the fund. The contribution is 70% into the score from the performance component and 30% from the management component. And just a caveat there, that a fund needs to have at least 25% of its assets by value participating to contribute and ultimately get a GRESB score for the fund. Assets, similar structure, a management component, performance component, 50-50 ratio weighting for scores. And this is the first year where we've got that sort of formal split for assets into management and performance. As Stephen rightly pointed out, this is a pretty big year for GRESB infrastructure, being our 5th year. So last year, many of you remember, was 10 years of GRESB altogether. Real estate was 10 years old. We're very excited that this year is the 5th year of GRESB Infra, and it is really a marquee year for many reasons. Certainly can say that from a participation perspective, there were challenges this year. The obvious one being the COVID-19 crisis, but we're very pleased that participation has increased again this year as the sector responds to the growing investor demand for standardized and validated ESG data to monitor the sustainability of their infrastructure funds and assets. So what we've seen is, despite those challenges, we did extend the reporting period and we got a growth in the funds participating. The number of funds participating with both components being management and performance, and therefore obtaining a GRESB fund score, was 75 from 64 last year, and 118 did the management component. Notably, when we look at our coverage, the fund assessment is covering 38% of the infrastructure investor top 50 managers with at least one fund or more. And from a European perspective, they are the largest contingent, as you can see from the chart, followed by the globally diversified. So they're making up, quite the bulk, the European focused funds and the globally diversified funds. When we come to assets, again, pleasingly, participation in the infrastructure asset assessment increased by 8%, now covering 426 assets with a total gross asset value of 579 billion. The assessment now covers 32 of the 33 industry sectors that are defined in the framework across 59 countries, and that's leading to deep data insights for investors, managers, and asset operators. Looking at this breakdown of participation by what we call superclass sectors, transport, renewable power, and social infrastructure are the highest representation. Interestingly, data infrastructure grew from 21 participants to 38, perhaps reflecting the importance of this sector during the COVID crisis. And I think we've all seen that data infrastructure has really come into its own. Perhaps it was already happening, but certainly exploded as a result of this crisis. Data infrastructure now, connectivity is now critical infrastructure for our society. Energy and water resources also grew significantly, and most other sectors were stable in representation. Okay, now to the kind of exciting part that many people wait for, the scores. Big news this year is there's been a leap in scores for both funds and assets. So overall GRESB scores and component scores increased by 10 to 15 points on average. We had assets reporting on 6 continents, over 1,350 facilities making up those assets. That's a 19% increase. And the coverage, as you can see, is continuing to be dominated by OECD countries at this stage. For Europe, it builds upon its track record of transparency. The most funds and assets participating in the benchmark by value are from Europe. From a scoring perspective, globally diversified assets scoring the highest, although the number in that, as you can see by the value, is somewhat lower. For the rest of the regions, Oceania, Americas, and Asia scoring very similarly on average, while the European average is somewhat lower. And this seems to be because there are a significant number of social infrastructure assets in Europe, and we find that they typically score lower than some other sectors. There was an asset in Africa this year, but we don't show that score average for confidentiality reasons. It would be too easy to identify. Looking at funds now, this shows that big rise in fund scores. So this is our GRESB fund model, which is based on the 2 components, the management component on the vertical axis and the performance component on the horizontal axis. So you see those 2 dimensions coming together. As I said earlier, in that structure, the funds are eligible for a GRESB fund score when they report with more than 25% of their assets. And these are represented by all the blue dots. They have both dimensions. Those reporting with less than 25% only get a fund management score, and they're clustered on the vertical axis, the grey dots. So that average GRESB fund score increased from 55 last year to 65 points. And we're actually seeing the fund GRESB scores clustering a little bit in the top right of the chart, similar to the experience seen in the GRESB real estate benchmark. This performance improvement is, I guess, shown by the fact that only 2 funds saw their scores decrease this year out of all of those funds. And funds are improving so much that there was actually 13 funds that scored the maximum 100 for the management component. So people are really coming to grips with this. It's becoming mainstream and normalized. Looking quickly at Europe, overlaying, funds scores are very well spread, and the average is slightly lower than the global average. For the assets, the asset model, looking at, again, those 2 components of management and performance, we have got a caveat here that the past results we used to look at for assets were on the dimensions of what we used to call management and policy and implementation and measurement. They map approximately to the new management and performance components, and they're shown for comparative purposes. The big jump in scores for assets is clearly evident. However, unlike the fund model, we don't yet have a clustering in the top right corner. But that might occur in future years, something to watch. There is a little cluster of performance around scores, performance scores of 95 and 54 that you can see. I won't go into too much detail on that, but the 95 cluster is due to the fact that 29 assets actually scored full points for the performance component indicators, except for the certifications indicator. So you're getting a bit of clustering because those assets are performing and scoring well on their most material ESG issues. Overlaying Europe, again, big spread. There's a lot of assets. The average, again, being lower than the global average, as I noted earlier. Okay, looking across sectors now. This chart shows the assets participating in the sort of blue circle and their scores in the ring. The participation is strongest in transport, followed by renewables and social infrastructure. The best scoring sector continues to be network utilities with an average of 73, closely followed by power generation excluding renewables, 72, and renewable power, 69. The lowest average score is again for social infrastructure, as I pointed out, 47, but notably, this showed the largest score increase, 18 points higher on average than last year. So it's narrowing the gap to the other sectors, something again to watch over the coming years. The scores for the 2 energy generation sectors, being power generation excluding renewables and renewables, showed the biggest increases, up by 25 and 20 points on average, respectively. Coming to performance, this chart shows a little bit of information on some of our performance statistics. Lots more information on our website that I encourage you to absorb at another time. In this chart, we're looking at the reporting and the target setting on the key ESG issues. What we're looking at here is the proportion that are reporting or setting targets where those issues are deemed material. Investors are demanding greater reporting on these material indicators, and that is showing up in the change in the proportion reporting. So just to explain the chart, the hollow circles is the proportion that are reporting on that particular indicator. In this case, the first example is energy. The dashed line is those that are the proportion that are setting a long-term target, and the closed in circle is those that are setting a target for the reporting year. So you can see in every single case, there's an increase in target setting, and in almost every case, compared to last year, there's an increase in reporting. So this is remarkable. Everyone is picking up ESG. They're realizing that this is basic information that's necessary for good decision-making, and they're getting on with the job. So it's very pleasing to see. Public disclosure, we do a separate public disclosure assessment, and this is just going to give you a quick overview of that. This is based on publicly available data for listed infrastructure companies. And in this, we cover more than 200 listed infrastructure companies globally with a market cap of more than 2.5 trillion US dollars. I won't go through all of the details, but you can see the number of companies in the rings. And then we use a different scoring for public disclosure, an A to E grading, and you can see the proportion of A to E in the colors in the rings. But you can see the most obvious things here. Most or a large proportion of the listed infrastructure companies are American, then Europe and Asia, and a small number in Oceania. And we're seeing that probably the best performance from the listed companies is in Europe. They had the highest proportion of the A scores. A very exciting development on public disclosure is where by the end of this year, we're launching a new index based on this data. This will be done in partnership with GLIO, the Global Listed Infrastructure Organization. So the GLIO GRESB index will be launched by year end, and I encourage you to keep a lookout for that. Looking ahead, I'll go briefly through proposed changes. There'll be lots more information and discussion on this in the coming weeks and months. Just as a quick snappy run through though, we'll be integrating the resilience module for next year. It's run for 3 years as a separate voluntary module. We're not going to make major changes to the fund assessment, nor the management component of the asset assessment. For the asset performance component though, we're looking to make improvements to the indicator tables to further simplify and clarify reporting and take important steps towards performance scoring. So at the moment, much of our scoring is based on reporting and target setting that I talked about earlier. We want to move that dial more towards scoring performance itself. We'll be looking to add a development component to better suit assets in development, not just operating assets, and making important changes and improvements on data quality with automatic outlier checks built into the portal and live scoring, whereby you can see a draft score as you complete the assessment and get that immediate feedback. Okay, just a couple of quick intros in my final minute or two to the panel topics. The first panel is on ESG standards and approaches. And I think the thing I wanted to kind of point out here, and many of you probably seen this in the media and in the industry, there's a lot going on. There's a big move towards both regulating and standardizing and harmonizing. And there's many players kind of getting involved in that. And the good thing is it is seeming to come together to at least a movement towards some kind of standardization and harmonization. We've seen the EU's taxonomy, of course, in the center. We've seen the 5 independent standard setters coming together to start to say, well, perhaps they should come up with a sort of a standardized approach rather than all continue to do their own thing. We've seen the World Economic Forum and the Big 4 accounting firms come out with a common framework for ESG. And we've seen organizations like IFRS say that perhaps they should have a board that, as it does for financial, also looks after standardization of sustainability and ESG reporting. So it's going to be very interesting to see how these standards progress and how the industry adopts and adapts to them. That'll be something discussed in panel 1. For panel 2, talking about decarbonisation and transition risk, I'll just share these brief results from our resilience module. We saw an increase in infrastructure assets and funds participating in the module, which is great, 60% increase on average. Interestingly, we saw a drop in the resilience score. And we think that's largely due to the fact that with that increase in participation, we're getting a few more of the followers getting into this game. They're seeing that they really need to get on top of resilience and TCFD reporting. And so naturally, perhaps they're coming in not quite at the same level as the leaders who were the first ones who took this up. So that's a natural evolution and maturing of the industry. Let's see how that gets discussed in panel 2. Another point I'll make is that infrastructure is fundamental to decarbonisation. If we're going to address transition risk and these challenges, we're going to have to decarbonise. And if you look at all of these measures, and I'm not going to run through them, they all involve infrastructure in either new types and new facilities to be built, or changes to the way that those facilities operate, like energy efficiency. We're going to have to get our infrastructure more energy efficient. So everything to do with decarbonisation seems to touch on infrastructure, which creates a big challenge, but also a massive opportunity. And then lastly, panel 3, which will touch on resilience and risk. COVID, I guess we couldn't go and conduct this session without mentioning it again. And we did some analysis of the churn and then the impacts of COVID on GRESB participation. We added that extra month for reporting, and I think that was really well appreciated based on the feedback from participants. Looking at the drop-off in assets, this is the total number of assets. I think it was 89 that stopped reporting this year, which is much higher than usual. And a good chunk here of that was COVID related. And if you look at the sector breakdown, perhaps unsurprisingly, a lot of those are in the transport sector. Some in social, some in renewables. Social, certainly health sector was hard hit. And even some in the data, but as you saw from earlier, data picked up massively despite that, so there were a lot of new entrants. So that's a bit of a teaser, again, on the impacts for us. We definitely saw some sectors that really couldn't participate in GRESB because of short-term COVID impacts, and that was definitely a part of our reasons for churn this year. And the last thing I'll finish with is sector leaders. So this is the celebration part. We award sector leaders for the best in their particular sectors in funds and assets. I'm not going to go through all the details, but the orange highlight shows the European winners. So congratulations to the leaders in funds, Arcus and Vantage being winning European awards, if you like, and the most improved. The first time we've provided most improved this year, and Macquarie and Delmore Capital, congratulations. When it comes to assets, again, highlighting in the orange, the European ones. You can read that in your own time, but congratulations to all those European assets. Some of you are on the line who achieved a sector leader top in your sector for this year. And lastly, most improved. So the new award for this year, these are the assets that achieved the biggest improvement in score for 2020. Congratulations to them. We would love to be having a face-to-face and sitting down and perhaps having a glass of wine afterwards and presenting certificates and getting lots of nice photos. This is the best we can do in lieu of that. There will be opportunities to do that, I'm sure, in the future. But we congratulate all those sector leaders and most improved and wish them all the best for the year. That's all for my presentation. Glad to have you all here. Really looking forward to the panelists. So let's get stuck into that. And I'll hand back to my colleague, Josine Peek.
Hi, that took a bit of time. Sorry for that. So now you have a non-Australian voice coming to you. After two, I love the accent, guys. Thanks, Rick. Thanks, Steve, for the great presentation and introduction. My name is Josine Peek. I'm a Dutch citizen, and I'm head of EMEA, working for GRESB. And I see we have when I last looked, we had 150 people. We're now 148 people. So that's quite amazing. All these people coming together and, you know, thinking and talking and looking at ESG. It's totally heartwarming. As Rick said, we're going to jump into, I just want to actually tune in with Steve with regard to the questions. We're not going to address them right now, but we will address them either in writing or during the further presentation.
Yeah, that's correct.
Right?
So possibly even Rick can answer some questions as they come in, especially I've seen some relevant ones for himself, and even in later panels.
Okay, because we don't want to go. We're yeah. Perfect.
Yeah, we'd love to answer them live, but just on timing, that won't be possible.
Maybe you can we just write the answers in the chat, then everybody can see them. I think that would be good. Okay, excellent.
Okay, go ahead.
Good. With that, thank you very much. With that, I'd like to see if we can have Ed and Rick, of course. Please let me see you guys. Yeah, there's Ed. Hi. So Ed is not only he's head of ESG at Aviva Real Asset Investors, but he's also part of the Infrastructure Advisory Board at GRESB. So really nice to have you. And Rick, of course, our head of infrastructure. So we have the topic we have is like a massive topic, and we have only a quarter of an hour. So it's really with regard to these standards. You know, we're an industry coming together around data in the first place, but data needs to be structured according to a standard. And up to now, we've always in the ESG world, we've had voluntary standards, and we have many of them. There's SASB and GRI and TCFD, et cetera, et cetera. Lots of acronyms, all voluntary standards. Effectively, GRESB is one of the voluntary standards. Now, all of a sudden, the EU is setting a mandatory standard for ESG data. And I also heard, but I don't know much detail about it, that last Monday, the UK said that TCFD was going to be for the UK a mandatory standard. So because they never do exactly what the EU does, but they do something a bit comparable. So the first question I wanted to ask you too is how will mandatory standards shake up this landscape of ESG reporting?
I mean, Justine, I'll come in on that first. I think, you know, there's been a lot of talk about SFDR, particularly over the last few months. And if we just stand back for a moment and ask ourselves, you know, what will the role of SFDR be? And I think it's fundamentally positive. You know, if you think about, you're going to go to John Lewis and buy a washing machine, you have a little energy label on the back, right? That's going to tell you whether that washing machine is going to be, you know, efficient in the way that it uses energy for washing your clothes at home. And I think with financial products, that level of transparency has never been there before. So I think, you know, SFDR is a really positive move for the industry. I hope that in the long run, it will inspire a lot more consumer confidence than we perhaps have now in sustainable financial products. And I think the industry really needs to embrace it and to recognize that it's going to be something that's positive in the long run. I think in terms of the practicalities, you know, there's this debate between Article 8, where we're talking about funds that have environmental and social characteristics of some kind, or Article 9, where we're talking about truly sustainable funds, and, you know, the data requirements that are going to come up around that. I think, again, this is a really key point, because it's going to start to, especially in real assets where this is really, really needed, it's going to start to clean the landscape up a little bit. We're not necessarily just going to be looking at, you know, a plethora of different funds and not knowing which ones are going to offer certain types of non-financial returns alongside the traditional financial returns. You're going to be able to look at that as an institutional investor and have an awful lot more confidence. So I think that's really positive, and I think that it's also going to drive convergence with some of the existing voluntary tools. In infrastructure, we only really have one benchmark, right? And we all know what that is because we're here to talk about it today. And I think if we have that convergence between the two, where the data that we're already collecting and we're driving from our portfolios can also support the marketing and the clear, transparent sale of financial products in the market that give consumers that confidence that they're buying into a sustainable product, then that's a really, really positive thing. So I think we all really need to move forward and embrace it. I think on the flip side of that, if we think about the PPI scandal, so 38 billion paid out in claims against the PPI scandal since that was unearthed. Greenwashing is going to be the next PPI, right? So we don't want to be looking at that sort of scandal for the industry in 5 and 10 years' time.
Exactly. Yeah. Great, Ed. Rick, anything to add?
Not too much.
Will still have a role when we have mandatory standards?
Yeah, Ed's covered it super well. So I think the only part I'd like to add is maybe a little bit of a GRESB perspective on that. You know, at GRESB, we use all of the best standards out there and then adjust them and make sure that what information we collect, what data we collect, suits real estate and infrastructure. That's our bread and butter. We'll continue to do that, and it's going to be very interesting to see how all of this kind of alphabet soup of standards and measures, regulations does sort of play out. There's a lot of unknowns in that, we don't know, but I think it is really positive that we're seeing all of these important players coming together in some way. And even PRI and the World Business Council and Sustainable Development have come together in a partnership. Specifically, one of the key things they're looking at is how to get the industry to be more standardized in reporting. So I think they're not going to do that themselves. They're actually putting pressure on others to do that. So it's really pleasing to see our stakeholders, the investment world, coming together and saying, we've got to get better at this. Standardization is part of that. And let's see how we can work together on that. And GRESB will certainly look to play our part in that. That's what we see our role as.
Yeah, indeed. I mean, we are and a standard, but we're also, and that's actually our biggest work, is just a data gatherer, right? We just make sure that the data is there and that people can then do their virtuous work. We're the blue collar workers. The second question I have for you both is that, and actually it goes also to one of the questions that's been posed in the chat just now. Of course, infrastructure is a sector with very large positive externalities, and the framework, the ESG framework, the more standard ESG framework, is that actually equipped to also ensure that these positive externalities are correctly reflected and given back to the community, to the investors, to everybody. What is your view on that?
Rick, do you want to take that one first?
Yeah, let me start first. Yeah, and I think as we laid out earlier, that there are some challenges there. And the great thing this year with GRESB, we've seen that improvement. So I think we're recognizing that everybody's on that journey now, and the commitment is very high. Maybe not every single organization, but the commitment is really high now. And so I think people are up for the challenge of measuring the right things and then responding to that. So I think when it comes to things like externalities and a better measurement and understanding of true performance, I think the basic sort of building blocks are there, but we're not yet really doing it in a standardized way, and we're not doing it in a serious way. So I think we've got some hard work to do. I think you're right that there's a lot of positives to measure. There's also negatives. The basic kind of ESG data that GRESB collects is strong in terms of getting information on that, but there are gaps, and we need to work as an industry to address those gaps. It is more sophisticated, so you have to start to bring in some other things into that to get a true picture. And certainly we're conscious that we want to work with the industry on bringing those other things in, whether that's, valuation of those impacts in monetary terms. There's all kinds of ways we can go. We definitely need to keep having those conversations, start to bring that sophistication in a way that the industry can manage. Ed, do you have a view on that?
Yeah, a similar view, really. I mean, I think if we stand back just slightly to ask, what is the role of GRESB, and is it rewarding the right sorts of projects? Really, we need to ask, like, what does the world need? Okay, and the world needs battery storage, it needs carbon capture and storage, it needs electric vehicle charging. We need to transition to hydrogen. So for me, those are the sorts of assets that should be rewarded over and above. I'm just being frank, we don't need any more airports, right? We didn't need them a year ago, and we definitely don't now. I don't want to annoy anyone that's heavy in airports, but that's kind of a fundamental factor, right? We're running out of time, and the world can't afford investments into incredibly carbon intense assets. So that's one thing, is just this fundamental point. I think once we get past that sort of initial, what is this asset and what is it there to do, we're starting to see so much more alignment now over people's understanding and companies' understanding of what makes up a good asset. What's a good asset that's good for society, right? So we're starting to think about, is it Paris aligned? Nice and simple factor. Different people measure it in different ways, but is it Paris aligned as an asset? How does it expose the owner to climate risk or not, be it physical or transitional? Does it create positive or negative social impacts? And then fundamentally, is the asset or the company or the manager that's managing, is it managed well, right? And if we can understand those factors, we can understand what is the asset and what is it there to do? Is that good? Is that what society needs? And can we measure that? And how is this asset managed? And if we can take those two things into account, and we can reflect that, and we can score that in the right way, then I think we really can offer really insightful and properly transparent advice to investors, so that we can allow market dynamics to start to take over and allow this big wall of money that's still out there waiting to be invested to go into the right sorts of solutions and the right sorts of assets. So I'd almost throw the question back to you guys and say, can GRESB really do that? And if it can't right now, then how quickly are we going to get there?
Yeah, I think it's a great challenge that we're certainly up for, evolving to that. And you do raise a good point about sort of the hard to abate sectors. We've got to start facing those and what happens to those. And there's social society questions, as well as GRESB and infrastructure questions as well. And so it's good that I think that that discussion is happening out there. We need to tap into that and work with that. And in a way, in some ways, they need more attention. You know, we need to work out how, say, you're using your example, how air travel can be sustainable, or how at least travel can be sustainable. These issues need to be confronted, and we need to provide the measures that sort of say, is this measure heading in the right direction, or is this heading in the wrong direction? So I think, you know, there's going to be a big focus on, yes, the green sustainable sectors, but there also needs to be a focus on the hard to abate difficult sectors, and what are we going to do with those, and how do we know they're heading in the right direction?
Great, thank you.
Josine, I'll just give you a 4 or 5 minute warning. So time for one more question.
Thank you, Steve. That's good. You're not visible though, Steve. I would always show yourself, but now it's a bit eerie to hear you from a dark box coming. Now, one more question. That's for sure. Let me see. We had one more. Yeah. So 2020 is really becoming an inflection year. It looks like, you know, it looks like one of the inflection years, I think, for everybody, almost personally as well. It's such a, you know, seminal year that we're going through. But what we're seeing, of course, is that a lot of trends that were already there are speeding up. And the good news is that the trend of ESG, which was already there, is truly speeded up. So we're coming of age, I think, as an industry, which is fantastic to see. But, you know, at the back of my mind always is, you know, are we doing enough? Are we going at speed, at scale? You know, are we actually making sure that this process is going to happen in time? It almost goes a little bit in hand with the question we just had, but let's take an honest stock from a macro perspective. We're moving in the right direction, yes, but are we doing this at speed and at scale enough to make a dent?
Yeah, I'll take that one first, Josine. I think, you know, I'll start with a quote that basically sums up my approach to this. So it goes like this: critical thinking without hope is cynicism. Hope without critical thinking is naivety. And I think this is really important, right? Because we could hope that the industry will just magically turn on a penny and solve this in 5 or 10 years. That's probably slightly naive, okay? But we also need to think our way through this problem. You know, there is an answer in here somewhere. Humans are amazing creatures that have done incredible things, and we can work our way out of this problem. How I would address that to people in the audience today and about their organizations is to ask themselves the question of, fundamentally, is your organization at the point where you've got good data and good levels of transparency, both about your existing portfolio and about potential investments? And is that driving capital allocation? Ask yourself that question. Is it really, really driving capital allocation in your business? Because if we can get money flowing to the right projects, then we can speed this whole thing up an awful lot quicker. I think another question to ask yourself, you know, is around the view of the future and the view of risk, right? Because my view is that risk and return at the moment is largely what's driving capital allocation. And yes, we are getting much better as an industry at integrating ESG into that process, for sure. But I don't think we're yet at the point where we can take a long run view of the potential catastrophic risks to the system and be able to explain those and understand them and really work them into our analysis and our understanding of what comprises a good investment today. I just don't think we're there yet. So I'd encourage people to maintain that sort of that sense of hope and of opportunity, of looking forward and thinking into the problem and looking forward and leading their organizations in that respect. But also, you know, maintaining that level of self-criticism to look back at your organization and say, are we really doing it? And are we really using the right data, the right insights in the right places to be able to drive those sorts of behaviors?
Yeah, and I'm very hopeful too. I think the slide I showed earlier on decarbonisation, that is a massive opportunity. And I think if there's one thing that excites infrastructure investors, it's being able to invest in growing new, exciting areas because they're going to grow enormously. Look what's happened with renewables in the last 3 decades. It's just a great area to invest. It's harder now, of course, because it's so competitive. But think about all those ones who got in at the right times, grew something out of nothing, and now where they're placed. And I think we're going to be actually surprised by how fast some of these sectors move. You mentioned battery storage and things like that. hydrogen. There's a whole range of these completely new, in a way, technologies, sectors, economies, which are going to arise and are probably going to surprise us and solve some elements of the problem quicker than we expect. And that, because using the example of renewables and batteries, but it won't necessarily be enough. But I think that's where investors will really push things very fast. And I'm very hopeful about it. There'll be other areas that are sort of more there to mop up, and some hard choices and some transitions to make. And we need to make sure those transitions are just and protect and look after people. That's going to be critical, and perhaps governments have to play a little more role there, because we don't want this to be an uneven and unequal transition that we make. It could easily be if we don't take care. So I think incredibly optimistic and hopeful. I think because investors will get behind the opportunity that this means, and then we just got to make sure we don't leave people behind.
Great, guys. With that, I'm going to give the word over to, first of all, I'm going to thank you, of course, for your great comments. And then I'm going to pass the word to Eric Landry, my colleague. He is our specialist on carbon at GRESB, and he will moderate the next panel. And I think we're going to be turned off again.
Thank you.
Hi, Eric.
Thank you.
Thank you, Yozine. Wow, what you know, to say the least, an inspiring panel that just was. A lot of forward thinking, and as Ed said, trying to steer away from naivety and actually go forward with a clear head and a good path. Just a little tidbit that I saw recently. Airbus released a couple concepts where they think they can put a plane in the sky that's emissions free by 2035. So maybe the airport scene could play a role, but I won't speculate on that. Really quickly, just to kind of just address one of the points mentioned in Rick's presentation with regards to the resilience module. Again, participation starting to really take off, but then scores may be dipping a little bit. And yes, we can see that a lot of that is due to kind of the newcomers not quite knowing exactly how to kind of boost their score or what things to report. But it's really interesting to see every single one of the fund reporters, the fund participants that filled out the the resilience module for 2019 and then again for 2020. Every single one either had a consistent score or went up. So what does that mean? Necessarily, that means that the people who continue to report outpaced and outperformed in terms of average anyone who joined for the first time. So we see as a participation going up, some newcomers coming in, the scores will dip a little bit, but we expect that to come back around as they continue to report and get better and better at the management practices on which they're reporting. Then it just goes to show that we're really at the beginning of that curve. So that's exciting to see. And we have two panelists here today who are at the front of that curve, and we're going to have a great conversation about not only climate-related risks and the management of those, but also how to set decarbonization targets and what that means for their respective roles and positions. So, David, I'm going to ask you the first question. Over at Atlas Infrastructure, I know we've spoken a lot about kind of your take on transition risk and how you implement and integrate that into your portfolio decisions. I think it's really great, and I just really would like you to share that with the group.
Yeah, sure. Thanks, Eric. So I wanted to, I guess I thought I'd start off by sort of maybe picking up something that Rick said, which is that obviously infrastructure is probably one of the sector that is touched by this transition issue the most. It's the sector that is probably the linchpin to decarbonisation and energy transition. I guess flipping that on its head for us when we started our firm about 4 years ago and started to think about, okay, what are the risks? What are the things that we need to anticipate for infrastructure over the next 20 or 30 years? It wasn't so much, well, infrastructure is important in the transition, but that actually the energy transition for us is probably the most profound impact or profound risk for infrastructure that is guaranteed to hit us at some point over the next 10, 20, 30 years. So the challenge, I guess, that we had 3-4 years ago when we started to think about this was, okay, we have a good sense that this is coming. How do we take that into account? How do we make sure that when we're trying to work out whether we should buy an airport or an electricity network or a gas pipeline, how do we make that evaluation? So what we've had to do, I guess, going back 3 or 4 years ago, there was no consistent tool. There was IEA forecasts and there was some sort of more high level work being done, but there was no actual, wasn't certainly the same level of sort of tools or support that we have today. So we really had to develop something from scratch. So what we did was to say, well, there's, a bit like what happens today. There's 3 scenarios. We take action, at a moderate pace. The transition happens and it happens over time, and we sort of hit a 2 to 3 degree scenario. Not ideal, but probably, especially at that time, the most likely scenario. But what actually happens if the world takes more profound action? What happens if countries do actually meet their Paris targets? What does that look like for our assets? So what we had to do really from scratch is set out the policies that governments would implement to achieve that. And so we now model all of our assets according to these, well, particularly these 2 scenarios, and also an awful scenario where we don't actually do anything. The benefit to us taking this approach really is it's enabled us to be much more explicit about differentiating between what happens to different companies in different environments. So we don't just take some sort of high level guess that renewables are good and fossil fuels are bad and airports are neither good nor bad. But we can actually say, what do we think this asset will do in the next 10 or 20 years in this scenario or in this scenario? In the same scenarios, what do we think these other assets will do? So it's enabled us to really evaluate all the assets that we look at. And we, given that we're in the listed infrastructure market, we have 150 assets that are in front of us from which we have to choose. And so, a crucial thing for us is being able to do that on a consistent basis, I guess. And what I'll just finish off quickly. What it really enables us to do is really look beyond maybe just the next 3 or 4 or 5 years, which is really the scope of what most people in the listed market are doing, and even what you do when you look at scope 2 or 3 emissions. Even you need to be able, when making these investment decisions, you need to be able to look beyond this 4 or 5 or 6 year time frame to go, what does this company look like in 10 years? What does this company look like in 20 years? How are policies going to shift? What position does this form in the economy as we look forward 10 or 20 or 30 years? And that's really, having that long-term perspective is essential, because it's actually in the longer term that some of the most significant and important differences between assets start to become apparent, and that's enabled us to really, I guess, shy away from assets that might appear to prima facie to be attractive, but actually have relatively unattractive long-term characteristics. And by that I mean particularly things like some of the gas infrastructure, which, gas is definitely an interim fuel, but if you look 10 or 20 years ahead, maybe it's not going to be quite as much of the energy mix. So that was a very long answer, Eric, but hopefully that's a quick overview of how we look at it.
Yeah, but lots of really good points in there. I just want to highlight kind of the level of kind of bottom-up sophistication of some of the modeling you're doing. You say you actually model the different policy progressions along a number of different fronts, whether it's energy efficiency policy, electric cars policy, renewable energy standards, things like this. You actually build the policies into the model and don't just have some sort of overarching carbon price that you just come top down from and say, okay, well, everyone's going to have to pay $50 per ton of carbon or something like this. You actually build the, supply and demand structures from the bottom up. And that gives you a lot of granularity, I imagine. Yeah, it's essential that we do that, because often assets
often these assets actually look quite similar. You know, they might have a similar carbon footprint per megawatt generated. In fact, sometimes it's actually the companies that have the worst current say carbon footprint that are actually the ones that are most in transition to get rid of some of that, to close down their coal-fired power stations. They're the ones who will grow their asset base. The ones that we're actually more concerned about are the ones that almost look quite similar, but where they've got relatively new undepreciated assets that may actually have to be shut down before the end of their natural life, whether that's a pipeline or some like a combined cycle gas power plant, which will be fine for the next 5 or 10 years, but it's got a 30-year asset life, and you have to end up writing it off. So, you know, it's very important to take a bottom-up approach when you're actually looking at the impact on each asset. Obviously, if you're looking at what happens in a country, then you can afford to take more of a top-down approach. But that's we're not buying countries; we're buying assets.
We're not buying countries, we're buying assets. I like that. I'm gonna switch gears and switch on over to Bent. Bent, you know, it goes without saying that transition risk is probably becoming more important to many more of your clients. How do you go about seeing kind of the prioritization of maybe climate risk type processes above and beyond, say, the kind of standard or traditional ESG metrics?
Yeah, just as a way of background, I mean, we're Copenhagen based and we work across the sustainability spectrum, but we speak to asset owners and asset managers globally, and climate is on the top of the sustainability agenda, not surprisingly. So that's kind of one. But if we look at the Nordic asset owners in particular, and look at kind of what's the evidence for that in the Nordics, what we see here is that a significant number of asset owners are shifting either entire portfolios or dedicated portfolios to portfolios with climate commitments. And this can range from quite specific climate commitments to carbon, for example, like carbon neutrality at a given future point in time, to more general commitments, such as, for example, an allocation commitment of a certain amount to climate-friendly technology or to green portfolios, without that being necessarily further defined what that means. And finally, there's the even more general one, which is kind of overall policy commitments or investment strategy commitments to being Paris aligned. So clearly that's there, and that's an increasing trend. But the challenge that gives is, so what does that actually mean? What does that actually mean for your strategy, or how do you define what the green portfolio is, or what the climate-friendly technologies are, or what your Paris-aligned portfolio commitment actually mean in the numbers? Because if you look at it and think, okay, as wind and solar as previously as kind of the obvious choices to go to for kind of the climate conscious investor, here we're talking about, I mean, there's two changes here, of course. One is, as was mentioned previously, high competition for these assets. So that's a question of risk return, of course. And the other is that these asset owners are diversified asset owners. They're not impact managers or dedicated to certain sectors. So they're looking at a much broader set of activities. So how do you then measure your commitments? And that's where we're seeing this increasing need really to translate the broader mission statements or the broader strategy commitments into specific targets, into specific actions, and something that can be measurably reported on, so progress towards the targets can be tracked. And this is in a way very much a shift for the asset owners from the traditional ESG scores, where you would measure your sustainability profile with an ESG score, and you say, okay, we're average rated this or that, and that kind of, and there you go. And then the next level is, okay, you have your total carbon footprint. But that doesn't really mean that much on a portfolio level without actually putting in context of your investment strategy. So we're seeing really a big shift in becoming much more granular on identifying where you should measure, which again feeds into your investment strategy.
Yeah. Oh man, so much to unpack there. This kind of delineation between, well, first of all, commitments are forward-looking by their very nature, and that kind of differs from ESG performance in terms of, okay, you can see how you're doing, and if you can, obviously up is better. But what does it mean to set a carbon neutral footprint, and how do you build that in? For a sector such as real estate, it might be relatively straightforward insofar as, they only have a certain number of tools to go about. They have energy efficiency, reduce their energy, become more energy efficient, build in renewable energy, or procure kind of carbon neutral energy sources. Whereas for infrastructure, how do you? I mean, that's got to be one of the big challenges. How do you measure that? And it's probably very diverse across the different parts
Yeah.
of the infrastructure asset class.
Absolutely. I mean, you can say that real estate is real estate is also like, let's say it's a handful of sectors within real estate, depending on how you break it down, right? But when you look at infrastructure, the complexity grows significantly in terms of just a diverse range of activities that you're talking about. Because we talk about sectors, but really it comes down to the activity. What's the activity of the entity that you're purchasing, or that you're investing in, that you're holding? A company, of course, can have multiple activities. So how do you break that down? And for certain activities, it's relatively easier than for others. So electricity generators, kind of, and then you have a pathway. It's out there. You can look at it. I mean, there are different pathways out there that you can look at, but it's relatively straightforward because it's one relatively. It's a single activity measure, if you like. So it's your CO2 footprint per kilowatt hours, or how you want to look at it. And there are other parts of infrastructure where we can do that. For example, on the rail sector, you look at, okay, what's the carbon footprint or the CO2 emissions per passenger kilometer, etc. But of course, when you get into more into social infrastructure or other sectors, or kind of more activities which cannot be measured by a single activity measure, it's really getting really hard to compare. So this kind of drive for a common standard only works as far as it's relevant, because I mean, our starting point would always be to look at, well, what's the financially material factor to look at for that asset, and where does climate risk fit into that? Now we're talking about transition risk and not physical risk, but if you take transition risk, so where does climate risk fit in the activity, and how does that measure up against other risks that you're looking at? Because clearly climate risk is just one out of multiple risks that you're trying to model. So it's not an easy point for such a broad sector, sort of broad kind of industry, if you like, if you just start just by saying infrastructure. But having said that, just one way you can look at it is to look at it via the EU taxonomy lenses, if you like. The EU taxonomy can be looked at as if you like, as a compliance tool for reporting. So how aligned is your portfolio? But another way to look at it is as a tool to identify pathways for carbon, because it's really about either explicit or implicit pathways. What is the EU trying to achieve via the taxonomy? So even if you look, so for example, for rail again, that's a pathway going from 50 grams CO2 per passenger kilometer today down to 0. But for let's say data centers, it's not CO2 per terabyte. It's a code of conduct for energy efficiency. So it's kind of a different way to translate it. But the point is that the taxonomy is driving a lot of this as well. At least that's what we see from our clients, and that's gonna be a big force in putting more numbers on the table rather than just statements.
So we're seeing this kind of, as you said, it depends on what lens you look at it through. So over here, we have the kind of commitment top-down lens of, is something Paris aligned? Is it a sustainable investment? And then you have this lens over here that's, okay, well, what's the actual risk that either transition or physical risk that, climate will have or map onto a particular asset? And trying to put those together, we want, I guess, thread the needle of that space in between. And granted, they do overlap. That's why I would say a lot of early efforts in an effort to try and mitigate transition risk start with, say, trying to align with kind of overall sustainable standards and things like this. But you know, these are two lenses, and they have this kind of intersect that we're trying to weave into. David, do you have a?
Yeah, it's quite interesting. It's you know, I don't envy sort of our clients in terms of how they're trying to navigate this, because they're getting a message down from their board to say, you've got to do this and that, and they're like, oh my God, what do we do? There's no common framework. How do we? And they're like, I'll tell you what we're going to do. We're just going to put a whole bunch into renewable energy. That way we know we're in the right area. But that's not necessarily, that kind of works from a decarbonisation perspective, but you end up with massive concentration risk. And you also end up actually potentially going into a very overcrowded space. As I say, I don't envy people, but it's the more you can think about actually how do you balance that, you know, being in the right places to be facilitating the energy transition. I think it's that facilitation that's the key thing. How can we make sure that we're in an industry that is relevant and has a positive impact over the next 10, 20, 30 years? It doesn't need to be right at the forefront in terms of actually having a spinning turbine. It means that you're providing the infrastructure that will enable the decarbonisation of the economy. And that can include rail, that includes particularly in our investment universe, that includes massive investment that's required in the electricity networks, because it's all very well having a solar farm or a wind farm, but you've got to get those electrons to the end point, and you've also got to get them to that point in a balanced way that sort of, you know, meets the actual end users' needs. So I'd encourage investors to think, to the extent that they, you know, have the capability internally to do it, make sure that they're not just sort of going, oh my God, what do we do? Let's just go into renewables, because increasingly we're seeing that as a very crowded space where actually there's actually more risks than you might think. That's probably enough for me, and I see Steve is champing at the bit to kick us out.
Okay, well, if Steve will give us 30 more seconds.
Yeah, go ahead, Eric. Thanks, gentlemen.
Thanks, Steve. Bent, really quickly, we had spoken before earlier about the importance of engagement, and I think that's just a really important message to go ahead and end on. So if you could say 2 sentences about that.
Well, basically, if you're starting with, if your starting point is material, and from a financial point, then my experience is then you have a basis for engagement, and that's the way to start. Not, and if you're starting from wanting to save the world, however important that is, it becomes just more tricky to have a common language. So it's all about having the language of the whether it's the company or the asset operator that you're speaking to. Just showing that you understand the asset and what's the material for the people on the ground, and you have a common ground for starting the discussion.
Great, perfect. All right, Steve, over to you.
Thanks again. Katie, up next, panel 3, last but not least.
Thank you, David, and thank you, Bent, again for your time. Really great discussion.
Sure. Thanks.
All right, Katie.
Great, thanks, Eric. Thanks, Steve. Yeah, we have a fantastic panel coming up. So we have Bansi, Des, and Catherine, who are joining us. And as mentioned, Bansi gets extra points for being on parental leave and still joining in. So really amazing. I think you're the only person for whom the digital event works better than the actual physical event, I think. So we're really glad to see you anyway, and also if you really. We prepared for this call last week, and we had such an interesting conversation that I'm sure this panel is going to be highly interesting to everyone who's still here. So thanks for coming. And I'll just give a brief intro to the topics that we're going to be discussing. So as Rick mentioned earlier, we've seen a bit of churn, obviously, from COVID. And I have to say, when it was April and we opened our portal, and we got a lot of questions from participants on participation and on the reporting period, and whether they would have enough time to do that. And we actually gave everyone a bit of an extension. So we extended our deadline a month later. And we were a bit worried at that point that we would see a major drop in participation, and we were a bit worried. So by the time the portal closed and we saw that there was actually an increase in the number of participants, both in the fund and asset assessment, we did a little happy dance, because we were a bit unsure at some point that that was actually the case. And I think that really demonstrates the commitment that the industry has when it comes to ESG, transparency and disclosure. So that was a really positive sign. And yeah, so that's something we're going to be discussing today as well, is what COVID means for ESG priorities, both in the short and medium term. But I think, first of all, everyone's really keen to hear how you experienced the reporting period with your assets. Was it difficult for them to participate, and what kind of challenges did you encounter on that? So we'll start off with Des, if you want to give a quick intro on this and just give your thoughts, and then we'll go around the group.
Yeah, I mean, in terms of our portfolio, and as we've seen at the top of the presentation, you know, transportation assets have clearly been impacted by the crisis, and therefore it has had a knock-on impact in terms of the reporting. So for our portfolio, you know, we've seen Eurostar has been impacted, as well as a portfolio of Spanish roads that we invest in, Iridium Hermes Roads, and Scanlines, Scandinavian ferry business in particular, you know, and clearly these businesses have suffered as volumes have dropped off as a result of travel restrictions, associated lower demand, and therefore they've had to carefully manage costs, which has included amending travel schedules, but also calling on government support schemes where these have been available to furlough staff and protect jobs. So actually, some of the staff members who would have been responsible for reporting to GRESB, you know, have actually been put on furlough, which has clearly been a challenge for us. I think it's important to note that not all businesses are affected in the same way. So even though transportation has been heavily impacted, Eurostar for us has been more exposed because of its reliance on leisure and business travel, for instance, whereas Scanlines and Iridium Hermes Roads have been impacted, but they've been relatively more resilient as a result of their freight businesses, but also a pattern we've seen of people migrating more to car travel as opposed to using public transport because of concerns over the virus. Then from point of view of utilities, because we also invest in a number of utilities companies, these businesses have been impacted sort of operationally in terms of the ability of their staff and contractors to get out on site to carry out customer-facing work. But the businesses have responded well to this, and they've all invoked robust business continuity plans. There's involving a high degree of national coordination as well to ensure continuity of essential services, you know, water, gas for heating, and so on. With these businesses, staff have been reclassified as key workers, and that was important. And I think just generally given the essential role played by these businesses and their overall resilience to the crisis, the decision was taken not to furlough staff. And therefore these businesses have continued to participate in GRESB, which we've encouraged. Yeah, I think just finally on the renewable energy assets, I've seen a couple of questions come in on this as well. I mean, from our perspective, again, operationally, we've seen these businesses largely unaffected, with asset managers being able to work from home or O&M providers carrying out work on site in a socially distanced manner. I suppose economically they've been impacted by suppression of power prices brought on by COVID, but operationally they've been okay.
Yeah, thanks for that. I saw Catherine nodding very vigorously at some point. Do you want to chime into that?
Yeah, it was just really the comments about the renewable power, and interestingly, you know, a lot of what Desmond just ran through kind of replicate some of the trends, the challenges that we've seen across our portfolios, and to bring a bit of context to what BlackRock's infrastructure portfolios actually look like. Across our equity platform, we have a high energy exposure, both kind of conventional energy, but also renewable power. And so we saw a really mixed story across those investment strategies, not in terms of GRESB commitments, and we actually had higher fund level reporting this year than we ever have before, but actually cascading down the responsibility to the data collation at an asset level was challenging. And so we hope to increase our asset level reporting next year. But it was a really mixed story. And part of that was obviously the virus crisis initially, as it started to kind of spread across Europe and US. We actually saw oil pricing volatility across the markets as well. So that did impact our midstream. Actually, across our renewable power, we've seen very little kind of impact from COVID or the pandemic per se. And that is really, you know, the sun has kept on shining, the wind has kept on blowing, and actually renewable power is generally less correlated to general market factors as well as kind of virus responses. And actually in the same breath, we've had an incredible year for fundraising in renewables. And I think part of that we'll touch on later in the panel in terms of, you know, this evidence that we've seen of kind of sustainable infrastructure is resilient infrastructure. And this is something that's really played out across the infrastructure sector whole with the pandemic. Again, kind of no surprise across transportation exposure that we have through our infrastructure debt, rail, airport, toll roads. We've obviously seen near-term disruption because there's been less business travel, there's been less tourism travel. And that's something obviously that we have seen impacted. I did want to just mention actually a specific asset that we do report into GRESB. And this was a hospital asset that we have in Zambango, which is a state just north of Mexico City. It's actually one of the sector leaders that was called out on the slides earlier. And I think this is a really unique example of how, you know, something like a pandemic or a shock to the market can really impact infrastructure. This was a hospital at the forefront of the pandemic. And actually, when we think about our role as an active asset manager, you know, there was repositioning, physical repositioning of that asset in terms of converting an entire wing into a COVID response unit, and actually kind of thinking about staff resourcing. And I suppose it brings to life some of the themes that have been discussed in the panels prior to this in terms of actually as infrastructure investors, we're investing in societies and we're providing critical infrastructure to local societies, and hospitals was one of those, but it was also one of the sectors that we saw kind of faring well in the sense of demand, but then there was actually the impact of kind of over demand on that. And I think, you know, digital infrastructure and telecoms is another clear one within infrastructure more broadly, where we've just seen kind of a surge in demand and actually a very different kind of reaction, different kind of response. So definitely varying degrees across the sector as a whole. But again, as I mentioned, you know, this concept of resiliency has kind of really been brought to life. And I think, you know, when you think about a liquid and long-term nature of investments in infrastructure, it's one of those asset classes that actually, you know, does generally perform well against shocks to the market like this. But, you know, it's obviously at the forefront of societal benefit and the forefront of societal service. So yeah, huge varying degrees in how we fared. I suppose my last comment on that would be, I think, you know, our commitment to GRESB remains unwavered, and if anything is amplified, because actually just this concept of increased transparency, increased reporting, the rise of the S and ESG is all being kind of come under a much stronger spotlight by the pandemic. And so I do think we'll expect to see even greater reporting within the benchmark next year as well.
Yeah, that would be really great. And it's great to hear that the commitment is there. I think, Bansi, we talked a little bit about this as well. I think this is something you mentioned last week when we had our prep call, is that obviously the health and safety of employees has gotten a completely different dimension this reporting season. Not just, you know, obviously next year we'll probably see those results in the data that we get, but this year it's more in the actual being able to provide the data. So how is that experience in getting people safe and ready?
Definitely, no, completely. That's completely right in what we've been seeing this year. So at Arcus, we invest in European infrastructure assets across telecoms, transport, and energy. And very similar to what my colleagues there, Catherine and Desmond, just said, we saw an impact across all our assets, but to varying degrees. I think firstly, and especially on that comment that you just made about the social side and health and safety, it's really important to commemorate how well companies responded to the pandemic and how quick they were in that response. They really made sure, especially with the portfolio companies that we work with, they really made sure that they prioritized the health and safety of employees, but also customers and the local community, to make sure any critical situation could be avoided, but then also in the challenging environment to continue to operate as core infrastructure providers. So that was really great to see. And we were really pleased that the work we have done along with those companies to invest in sort of resilience and business continuity planning, as Desmond mentioned as well, had actually paid off, because a lot of these concepts had actually been explored maybe theoretically, but had never had to be put into practice. And then on that social side, as you were mentioning, I mean, up until now, health and safety was always something that was very, so maybe a policy here or there, or some rules and regulations that the company set out to make sure that if there was an incident, it would be that we could avoid any core incidents, but we could also respond quickly to any incidents that were, you know, very much above board and on paper, something that was quite easy to respond to. But I think the pandemic has reshaped the way we think about health and safety, and it has forced us to think internally quite a bit. We've seen that not just the pandemic affecting social side, but there's been a knock-on effect on the whole of ESG. But up until now, I think it's the S that's really come to light in this pandemic, because it was more of an area of a gray area, where until now corporate social responsibility would be something that was used to tick off the S box. And COVID has meant that actually companies are exploring, what does S actually mean? So is it just health and safety, or does it then incorporate the well-being of staff members? Is it better management of supply chains? Is it better planning for business continuity? So in that respect, I think the S side of ESG is really transformed.
Yeah, for sure. And I think this is something we touched on last week as well, is that obviously what you mentioned, communities are suddenly, from being these sort of external things to an asset, which you sometimes maybe engage with depending on the nature of your asset, now actually are really relevant and really affect your actual operations, even if you may not always be in touch with them so much, even if they're not always your users. So that's like something that's very interesting to me. And I'm really curious to see next year what we're going to see in terms of data from all the assets on that. And that kind of segues very nicely into the sort of second part of this discussion, which is on the sort of medium to short-term priorities that are going to be affected by the COVID pandemic. The S is obviously getting a new dimension almost, but how do you see that shifting next year? And what do you think will that effect be, maybe in different sectors or different regions? So let's go to Desmond, so because you haven't spoken for a while, and then we'll go back to Bansi and Catherine.
Great, yeah. I mean, I think what we're seeing is that COVID has really brought about an acceleration of trends that were already taking place to some extent. So, you know, for example, the sort of the social side, and Nancy's mentioned looking after staff welfare, which includes a focus on, you know, particularly on mental health concerns at the moment as well. But it could also be customer preferences for greener modes of transport, such as trains, you know, or use of technology to work remotely, or hold board meetings. We've been dialing into various board meetings remotely, you know, instead of taking airplanes or other modes of transport. And more broadly, it feels that people are embracing, you know, or were embracing during the first lockdown, fewer cars, being on the street, a return of natural wildlife to local environments. So, you know, again, I think it's really reinforced this the whole decarbonisation and net zero agenda.
Yeah, that's really interesting. And Bansi, do you want to respond to that? Do you see sort of more a shift also from different stakeholders towards that net zero approach in terms of travel and transport?
Yes, definitely, very much agree there. So we talked about that short-term impact from the social side, but there's definitely been a knock-on effect onto the E and the G of ESG. So we've seen, and also the last two panels have highlighted just there, that how much the sustainability and the climate change agenda is more important than ever right now. And then, and how COVID has actually helped to reset those priorities in order to be in better shape to meet those goals. So I think those 2030, 2050 things that we're working towards achieving, COVID and the change in the way that people go about their lives, remote working, and not as much use of public transport or emittance has just meant that people, that there is a reset factor there. So I think there's definitely going to be a positive impact on the environment, and in the medium term, a definite push for those climate change and sustainability agendas. And then on the G side, I think there's definitely an impact on governance as well. So the importance of strong governance has come to light and has evolved as a result of this pandemic. I think we see increased demand from our investors for better ESG buy-in from CEOs and top management, as well as other behavioral traits, so that we're looking for people that manage companies in a way that will transform their organizations and not just drive growth and revenues. So there's a sustainable growth agenda, and I think that companies are looking for that buy-in from that top level and that will then shape what we see going forward and how organizations transform themselves. And I think that will then keep having a cyclical effect on environment, social, with that stronger governance. I think a further effect we've seen from COVID overall is that it's highlighted just how intertwined the whole world is. So how each country fits together in the global picture. I think we can learn from this in a really positive way, that that a small amount of change in one region, in one area across the world actually has a really big effect. And if everyone did come on board and take a commitment to drive change, I think it has a huge effect globally, as something negative as COVID has shown how quickly that can spread and create a negative impact across the world. I think we see the same thing on the flip side, and I think strong ESG buy-in going forward in the short term will really help to drive that global change. I think the last thing I would say is that COVID-19 has taught us that a sustainable business, a truly sustainable business, is one that is resilient. So the idea of resilience really comes to play this year in 2020, and sustainability, because of that, is a priority on an even higher level. So those medium-term impacts on E and G are here to stay, hopefully, and the social side, as I said, becoming stronger. It's just meant that, you know, ESG is a priority on a whole new level that we haven't seen previously.
Yeah, I think that's such an interesting take, especially the point you raised about global change. And I think one thing I was thinking about as well is, obviously we've talked about climate change for years and years now as something that, you know, how will we grapple with that as a society? And this year was really a moment where we could see how the world was affected by a single great event. And obviously there were different impacts locally, but overall everyone was affected in one way or another. I don't want to go too far, but obviously there are parallels to climate change there, even though the timescales are, you know, probably a little different. So having said that, Catherine, do you want to have some closing remarks? Because I do know we have a little time left, but not that much. So if you want to add
and apologies, because my system was crashing in and out, but I think it sorted itself just at the right time. No, I think a final comment would be completely seeing those parallels between the pandemic and the climate change as well. And I think, if anything, we could almost view the COVID pandemic as a bit of a practice run for climate change. The virus has obviously played out at a much faster pace than climate change, but the principles are fundamentally the same, which is, if you wait to see the impact of this shock, it is going to be too late. And if anything, I think the pandemic is a bit of a wake-up call for the global community. And there is a sense of, we don't want to come out of major disruption and essentially fall into another major disruption. And I do look very optimistically to some of the stimulus packages that are being developed to deal with a post-pandemic economy. Certainly here in Europe, we've seen some of the most progressive stimulus packages being announced, you know, with kind of allocations towards decarbonisation, looking at renewable power, real estate efficiency, electrified and sustainable transport. And actually, we've even seen big powers such as China hinting to green stimulus packages, you know, a couple of weeks after they were announcing plans to be net zero by 2060. I think the result we've seen in the US could hopefully drive some positive change in the US economy as well. And obviously Biden has already announced his stimulus plans. He's already indicated intent to bring the US back into the Paris Agreement on his first day of office. So I think ultimately this has potentially been a wake-up call that the global community needed. Obviously, it goes without saying, we haven't got the time here today to talk in detail about the very critical role that infrastructure will play in that, both in energy transition, decarbonisation, but also, you know, the provision of critical societal services. So I think we are at a turning point this year. And somebody mentioned it earlier in the session today about it being a inflection point. And I think, if anything, you know, we can really take 2020 as a time where we went through an incredible incredible catastrophic disaster in many ways, but hopefully that's a wake-up call that we need to not end up in another potentially more permanent and long-term catastrophe as well. So I remain hopeful, and I know Ed was talking about that. I don't believe it's naivety. I do believe it's hope, but obviously there's a collective global community role that needs to drive that agenda forward.
Great. I really like that conclusion and that little message of hope indeed. Thank you so much for this. I thought I could have talked for another half hour probably, or even an hour, but I'm sure people have busy days to get back to. Steve, have we got any questions for the panel, or just general questions from the audience?
No, I echo your sentiment, Kathy. I wish we had another hour for all panels, but I do see a hand that's been raised from Cohen Mika or Mika Cohen. So I'm just going to open up allow to talk. So you can go ahead and speak now if you would like to ask a question. I see you're on mute. Maybe the hand was accidental. No? Okay, no problem. Well, given that we're almost at the end, I'd just like to thank, of course, all the panelists, all the moderators. Fantastic job, and also to our global partner, WSP, for helping us put this event together. And also I'd like to give a couple of takeaways, a couple of notes that I've written down. So the first would be to highlight that despite the uncertainty in the world at the moment, but the new, so let's say the EU regulations and other standards, they provide opportunities for sustainability conscious managers to add value to their portfolio and assets. And also the same could be said for climate risk and how a manager can position themselves to weather transition and be successful in adaptation. And that the third panel, that was terrific. That echoed GRESB's findings that assets such as renewables have been less affected by the 2020 pandemic, and some of them excelled, whilst sectors such as transport, for instance, have been little worse hit. So thanks to everyone again. And GRESB, at the end of the day, we're excited to be part of these opportunities and changes, and will continue to act, as Josine rightly puts, the blue collar workers of ESG, so collecting, validating, scoring, and peer benchmarking quality ESG data. Okay, I think we've rounded out before our time. So thank you very much, and have a good day, and we'll speak to you soon.